Welcome to the debate. We are standing at perhaps the most critical inflection point Bitcoin has faced since the summer. The asset has just staged the sharp multi-thousand-dollar recovery, and it's now trading, pretty robustly in the $91,000 to $92,000 range. A huge pullback from the lows we saw earlier this month near $84,000. But the entire market, everyone from retail to the big institutional desks, is holding its breath for December 10th, 2025. That's when the Federal Reserve delivers its final policy decision of the year.
And the stakes are just enormous.
They are. The central question we have to answer is this. Does the underlying strength, the structural and psychological strength of this recovery, have enough inertia to push Bitcoin through that critical $100,000 milestone before year-end, to give us that Santa rally everyone talks about? Or do these persistent macroeconomic headwinds and some pretty significant technical risks mean we're headed for a deeper consolidation or even a necessary correction?
Exactly.
My position is clear. I believe the structural tailwinds, I'm talking extreme supply scarcity and just unprecedented institutional adoption, provide the foundation for an aggressive breakout towards six figures.
And I come at it from a very different angle. While I'll acknowledge the impressive long-term picture, I believe this specific moment calls for extreme caution. The market has become, frankly, over-reliant on positive Fed expectations. I'm going to argue that the technical fragility and the reality of sticky global inflation will likely lead to some real disappointment in the Fed's guidance, dictating a path of consolidation or potentially some severe downside.
Okay, so let's immediately anchor the bullish case in what we've actually seen in the market, in its behavior and the supply dynamics. That drop to $84,000, that wasn't a sign of fundamental weakness. It was a necessary cleansing event. It drove the fear and greed index down to, 23 out of 100, extreme fear? That reading is a classic capitulation bottom, where you see forced selling, margin calls, and it just flushes out the weaker hands. And what happened? Decisive institutional buying stepped right in to drive an immediate $7,000 to $8,000 rebound. The market rejected the lows. That resilience is a powerful psychological factor. But beyond psychology, the structural foundation is just overwhelmingly bullish. After the 2024 halving, new daily supply is capped at near 450 BTC. Yet the data from 2024 clearly shows that U.S. spot Bitcoin ETF inflows were outpacing that new supply by a factor of 2.4. We are in a structural supply crisis. The scarcity is then compounded by the fact that long-term holders control 74% of the circulating supply. Now you just layer on the immediate catalyst. The CME FedWatch data shows an 86 to 90% probability of the Fed delivering a 25 basis point rate cut. This diminishing opportunity cost for holding a non-yielding asset is the precise trigger needed to overcome $100,000 and push us toward the extended targets of 105, maybe even 110,000 by Christmas.
That analysis, and it's compelling if you focus so heavily on the supply constraints. But I simply don't buy that the monetary policy catalyst will deliver the breakout factor you're anticipating. The history of Federal Open Market Committee, the FOMC meetings suggest caution, a lot of caution.
How so?
The market has this very strong tendency to buy the rumor, sell the news. The expectation of this 25 basis point cut is, for all intents and purposes, fully priced in. It's what fueled the recovery from 84,000 to where we are now. If the good news is already to consensus, then the reaction to the announcement itself is often a liquidity event that triggers downside volatility, especially as large players de-risk. And beyond that, we have to address the ominous technical risks just hanging over the market. We've seen prominent analysis, including from Bloomberg's Mike McGlone, suggesting that Bitcoin has already broken below a significant bear flag pattern. For those who aren't familiar, a bear flag suggests that this recent upward move is just a pause before the dominant downward trend continues. If that pattern is confirmed, we could see aggressive pressure toward the $80,000 to $84,000 range, or in a worst-case scenario, down towards $66,800. And even if the Fed gives us the cut, global inflation is still sticky at 2.9%. This means the Fed is highly likely to offer hawkish forward guidance, meaning they'll signal a very limited number of cuts, maybe one or two for all of 2026. This would severely disappoint investors who are pricing in an aggressive easing cycle. and that disappointment will absolutely lead to a sell-off that overwhelms your supply narrative in the near term.
I see why you think that. I do. You're focusing exclusively on the potential for disappointment and the technical risk in that bear flag. But let me give you a different perspective on the influence of monetary policy, which is our first major point of disagreement here.
Okay.
You correctly identify that the risk isn't the rate cut itself, but the Fed's tone, their forward guidance. You fear a hawkish tone. If the Fed does emphasize sticky inflation or signals that, even after this cut, real interest rates remain restrictive, meaning rates minus inflation are still too high, then yes, the market will interpret that as hawkish and trigger that bearish scenario. But the question is one of resilience. The severity of that recent correction to $84,000 suggests that the easy-to-flush-out retail risk was already absorbed. The institutions that stepped in at $84K were not buying based on pure FOMO. They were buying based on the fundamental trajectory of the Fed. And that trajectory remains accommodative. It's moving from tightening toward easing. This structural reality should, I think, absolutely override the short-term sell the news dynamic. Why? Because institutional liquidity is patient. They will use the volatility from some hawkish nuance as a chance to accumulate, turning the decision into a momentum booster toward reclaiming that critical $97,100 level. And that's the level that definitively invalidates your bear flag narrative.
The flaw in that perspective, however, is the assumption that institutions are somehow immune to the cost of capital. You say liquidity is patient, but it's also rational. If the Fed delivers a cut but signals that the pace of future easing will be slow, say only a 50 basis point total reduction expected for all of 2026, that substantially increases the opportunity cost of holding a non-yielding risk asset like Bitcoin, especially when you compare it to high-quality fixed income alternatives. The marginal buyer at $85,000 or $90,000, particularly one operating on borrowed capital, is highly sensitive to the Fed's future path. If they realize the aggressive easing cycle they priced in is not coming, they de-risk. This isn't just short-term noise. It's about a foundational mispricing of future liquidity conditions. The Fed can crush sentiment, even with the structural benefits you cite.
Well, I would argue that institutional demand, especially through the ETF structure, has fundamentally altered how supply and demand interact. Which brings us to our second and maybe the most crucial point of contention: supply dynamics versus holder behavior. You conceded earlier that the supply crisis is real. Exchange reserves are down 21% since 2024, sitting at 2018 levels. Sellers have extremely limited ammunition to crash prices. This environment is just set up for rapid price appreciation if demand resurges. The liquidity coming from ETFs is structural, it's recurring, and it's largely insensitive to minor changes in FOMC rhetoric, because those funds are often tied to long-term asset allocation mandates.
I hear your argument about the tightness of supply, but the source of the selling ammunition might not be the exchanges. It might be the strong hands losing conviction. I'm just not convinced by the idea that sellers have limited ammunition. When we look at on-chain metrics, they reveal something worrying about the behavior of our most experienced investors. On-chain data shows that long-term holder or LTH distribution, these are investors who've held coins for over 155 days, has actually accelerated steadily since July 2025. This is a quiet distribution, and it intensified right around those very $84,000 lows you held as a capitulation bottom. This suggests experienced investors are trimming their positions, often at a substantial loss from the May high near 111,000. Why does this matter?
Well, if experienced investors are taking losses or reducing risk after such a deep run, it signals lost conviction and a deep structural weakness that has to be absorbed by new buyers. This isn't just retail fear. This is the market structure adjusting downward. The key metric to watch post-Fed is whether LTH distribution accelerates further. If it does, it is a strongly bearish signal that no amount of ETF flow can immediately counteract.
But the context of that LTH distribution is crucial, and I think that assessment overlooks the nature of bull market rotations. I concede experienced hands are trimming. That is a fact the data supports, but this distribution often coincides with short-term holder accumulation, where new liquidity, often institutional or high net worth individuals using these new ETF pathways, steps in. This phenomenon is characteristic of the early to mid stages of a bull market, not a late stage top. It's a healthy transfer of wealth from older legacy investors who may have a lower risk tolerance after years of volatility to newer, institutionally mandated capital. The structural tailwind of institutional appetite, driven by regulated investment vehicles, ensures that this coin rotation is constructive. For every LTH selling at a loss from $111,000, there is a major fund absorbing that supply, often with a longer, more resilient investment horizon. The net effect on price remains positive.
But the net effect is only positive if the buying pace can overcome the LTH supply and the macro friction at the same time. You are banking on a continuous, overwhelming inflow. My caution is rooted in the very high possibility of a temporary halt to that inflow if the macroeconomic signals turn sour. And we are seeing resistance above 97,000 precisely because the institutional flow is currently unable to overpower both the overhead technical selling pressure and this subtle LTH distribution. It demonstrates that the market's current capacity to absorb structural weakness is in fact finite.
Capacity is often defined by external catalysts, which brings us to our final and maybe most transformative point: policy tailwinds versus near-term volatility. You cannot discuss institutional capacity without acknowledging the unique tailwind of U.S. government policy. This is unlike anything we've seen in previous cycles, which were just dominated by regulatory uncertainty. I am referring to the establishment of the U.S. Strategic Bitcoin Reserve earlier this year and the persistent potential for the Bitcoin Act, a proposed legislative framework to authorize the purchase of up to 1 million BTC. Let's contextualize that. 1 million BTC is 5% of the total circulating supply. This is not just regulatory approval. This is a direct, unprecedented government financial endorsement. It fundamentally alters the long-term risk profile. It reduces perceived systemic risk to basically zero. The knowledge that a policy floor exists, a massive, sovereign buyer, means that any short-term volatility, even one driven by a cautious Fed, becomes a guaranteed buying opportunity. This structural backing fundamentally justifies taking aggressive long positions now.
And while I agree that long-term policy support is a paradigm shift for the one-year horizon, we have to separate that immense structural certainty from immediate technical and liquidity risk. Institutional confidence, even if it's backed by Washington, does not insulate the market from short-term leverage liquidation cascades. You can't ignore the mechanics of the market. If Bitcoin breaks below the immediate $88,000 support level on the back of truly disappointing Fed guidance, say they signal no more cuts until late 2026, that technical breach will trigger margin calls. It will trigger algorithmic liquidations. A liquidation cascade is simply mass forced selling, which accelerates price movement rapidly to the downside, potentially targeting $80,000 regardless of the strategic reserve's intentions for 2026. The technical setup demands respect. And right now, the weight of resistance at 97,000 is far more relevant to the year-end timeline than a potential act that may or may not pass next quarter.
But the geopolitical and policy factors are now integrated. The knowledge that such powerful state actors are interested in accumulating this asset creates a deep-seated psychological bid that limits the depth of any subsequent cascade. Whereas in previous cycles, a break of 88,000 might send us to 66,000, the perceived policy floor means buyers step in much faster, limiting the downside and making that 80 to 84,000 range a hard floor. Momentum is built on conviction, and structural conviction is higher now than it has ever been. The market is fundamentally tight and positioned to explode higher if this monetary policy friction is removed.
That explosion, however, depends entirely on interpreting the Fed's signals as unambiguously bullish. Given the sticky 2.9% inflation and the need for the Fed to maintain credibility, I maintain their guidance will be nuanced and disappointing to the over-leveraged long positions currently dominating the market. We have to respect the near-term gravity.
I stand by the structural argument. The convergence of supply scarcity, the clear evidence of a post-capitulation rebound, and unparalleled governmental endorsement makes the case for 100,000 before year-end viable. It's even high probability. If the Fed provides even moderately accommodative forward guidance on December 10th, the path to 100K and beyond is wide open, potentially toward 105 or 110,000. I believe long-term investors should absolutely treat dips toward 85,000 as exceptional value. I'd place the probability of the aggressive Santa rally scenario at 35 to 45%. The odds favor the structural bulls.
And we need multiple perspectives to truly grasp this complexity. While I appreciate your focus on structural optimism based on the persistent macroeconomic headwinds, which are real, the high risk of Fed guidance disappointing the market, and the technical weight of resistance at 97,000, the most likely immediate outcome is measured consolidation. The immediate push to 100,000 is deferred, but not abandoned. I predict consolidation between 88,000 and 95,000 through year-end. I'd put that at a 20 to 30% probability, which sets up a far more powerful and sustainable breakout in Q1 2026 when fresh institutional allocations typically arrive. The tension between pricing in the expected cut and the potential for hawkish forward signaling means that reaching six figures this month remains a serious uphill climb.
Ultimately, the nuanced outcome of the December 10th policy announcement, not just the action, but the crucial tone of the forward guidance, will determine which of our scenarios dominates the final weeks of 2025.
Indeed, the market is positioned for a major decision, and this battle for $100,000 is a perfect encapsulation of the tension between overwhelming structural strength and immediate monetary policy risk. The path forward is highly contingent on the Fed's next move.